Okay, I'll just take some time to go through my thoughts when it comes to this article. So, by the way, this article is from Thomas, my friend. So he wrote a post on 30th of October, why I'm taking profit in the stock market. So I put a link at the description so you can read the details. But basically what Thomas is trying to say is that right now, S&P 500 PE is at 29 times. So it is quite high as compared to historical PE. And then because of that, he actually think that it is time to take some profit and then hold some cash. So that's his positions. I just want to quickly give you my thoughts on these topics. So I think just now the chart that he was showing is just like a small snapshot, right? So I pull up this screen sharing here just to show that the PE ratio over the past, 100 plus years, right? So right now, indeed, if you look at the historical PE right now, it's actually at about 31 times. This is not forward PE, this is trailing PE. Definitely high because if you compare to historical period, right? I think around 2020, it was higher, and that was because of the recession, right? Sometimes earning can shrink and the PE looks high. That's one reason. And then about 2010, that was also global financial crisis. So also the earnings shrink. That's why PE looks high. And then before that, which was a famous bubble period, that was about year 2000s, right? Those level PE went as high as more than 45 times PE. Other than this period, right? I think historically PE ranges between, let's say, like between 5 to 20. As and when PE went up to about, like, let's say 21 times, right? Definitely it looks high. I do agree with this statement, like PE is high. So do I think that because PE is high, we should sell our portfolio and hold on cash and wait for market corrections? So that's something that I want to quickly discuss. So I came across this article, Does PE Ratio Predict Stock Market? This was written by Brian. So I put the link at the description as well. You can read through the details here. But I think the more important things that I want to highlight here is that this chart, right, is showing the PE, which is at an x-axis, versus the CAGR of the future 10 years. For example, there's a historical period where the PE in a certain year is, let's say, 15, right? And then the subsequent 10 years of CAGR, what's the return? You just plot it on the scatter plot here. The questions that we are asking here is whether the PE is a good indicator of future return. Because I think a simple explanation is that if the PE is high, meaning that you are paying a high price to buy over earnings of $1, if you pay a high price, that means your future returns will be low, right? I think that's the so-called the thesis. But this is some numerical numbers to see whether that's true or not. So as you can see here, the scatter plot, right, it is quite, I would say, clear that there's some negative correlations between the PE ratio and the subsequent 10 years returns. It is like trending down because if you see, if over the historical period, if you buy at high PE, say for example, like above 30 times PE, right, the subsequent returns, you are unlikely to get those CAGR numbers of above 10%, because CAGR of like above 10%, right, you're able to get those kind of high CAGR because you bought it very cheap level, right? Definitely, if you look at the correlations, right, it's negative. Just from that alone, we can say that there are some predictive power if you just look at the PE. So that actually support the decisions to just sell and then hold some cash, because you are not able to get high returns if you buy at too high of a PE. The second thing that I want to highlight is that just pay attention, right? This scatter plot, right? It is not like every dot, right, fall under this straight line here. Because if every dot fall under like a clean straight line, right, it just shows that it is a perfect correlation. The higher the PE, the lower is your prospective or future returns. So, but that's not the case, right? It's actually quite scattered around. Quite like noisy kind of chart, because I can simply like point two dots, right? Say for example, one dot around PE of 15, but you can still get a return of about 5%. And then I can point you another dot, right, which is like a PE of 25 times, but future return is at 10%. You can easily like look for evidence that actually this is not a good predictive power, because there are too many points where you can form a positive correlations where you buy at higher PE, yet you still get a higher CAGR. That's why I think the general consensus here is that if you look at the data, you try to do some regression, right? Definitely you are able to get the negative slope, meaning that there are some predictive power. But as you do a regressions and you are asking yourself like whether this is a good predictive power, the answer is actually no. There are just too much noise in this chart. There are just too much noise noise, and you can't be sure that just because PE is high, the returns will be low. So I think that's something that I want to highlight here because it is quite important. And lastly, just want to compare against the bond yields, because for example, right now, even if PE looks high, if you sell your portfolio and holding on cash, right, where are you going to buy? If you just sell your stocks, you hold on to bonds. Is bonds give you a good returns? So that one you want to pay attention to what is the current bond yield, because it might be worse. For example, you're selling a stock market at let's say like a PE of 31, right, which imply a earnings yield of about 3%. If you take the money and go and buy bonds which yield you about like let's say 2%, right, then you are actually making things worse. So you want to compare against bond yield. And the good thing is that actually right now bond yield is still relatively high. Okay. Then the second things, right, is that you want to pay attention to inflation. Because why? Because even if you invest in stock market and you are getting, let's say like a 3% yield, right? Remember, this 3% yield is actually a real yield, meaning that let's say if the inflations continue to be high, all these companies that we invest in, right, say for example Apple, they are just able to pass down all this increased inflation, right, increase in input prices, and then they just check up the iPhone price over year, and that's actually help out in terms of their earnings in the future. So the earnings that you are able to get from investing in stocks, right, they are inflation adjusted. So they can go up as inflations continue. So that's the good thing, right? And then if you invest in bond yield, say for example now stock, right, is 3% yield, and then if you invest in bond, let's say you can get 4%. You remember this 4%, right, is not real yield. It's actually nominal yield. So that's why it is not a fair comparison, right? And so for bond yield, to make a fair comparison, you still need to deduct out the inflations to calculate what is the real bond yield. So this is being shown in the chart here. So the red line, right, this is the expected earnings to price ratio. This is basically the earnings yield. The blue line is actually the 10-year treasury yield, which is the nominal yield, minus the 5-year expected inflations, meaning it adjusts out the expected inflation. That's the blue bar here. So I think maybe don't focus on the green, just focus on the red and blue, right? You can see that actually expected earnings to price ratio has been coming down, and the real bond yield, depending on which period that you're looking at, so it's currently at about 2%. So I would say that two things I want to highlight here, right? First thing is that definitely if you compare the expected earning yield versus the real bond yield, right, the stock yield is actually getting less attractive as compared to a few years ago, because it has been trending down and then bond yield trending up, right? So the difference actually becomes smaller, and you can see it's actually shown in this chart here. So you can see this chart. So the earnings yield minus the real bond yield, right, actually has came down. So if you invest, let's say in 2015 to 2020, you get something like a 6% equity risk premium, okay? But now it's only about 3.5%. It's less attractive now by investing in stock. That's one thing. It's almost like telling you to buy bond instead of the whole stock. But the second thing to pay attention to is if you invest in the expected stocks, right, the red line, right, even came down, right, let's call it like 4.5%, right? 4.5% is still higher than the real bond yield of about 2%. So it's still more attractive, right? There are mixed picture here. So if you focus on the relative, right, I would say that stock still give you a better yield. It's just that now, compared now versus let's say a few years ago, it is less attractive already. So that's one thing. So, and if you go look at this, is that yes, there's some negative correlations, and as PE is high, it just means that your future returns tend to be lower. That's true. But at the same time, this whole thing is very noisy. A lot of noise here. It's not a good predictive power. That's my thoughts when it comes to this topic. That's all about today's sharing.